Did you know that in 2026, over 28% of Canadian landlords reported losing money on their rental properties, not because of bad tenants or poor planning, but due to new government laws they never saw coming? What used to be one of the safest and most reliable investments in the country has suddenly become a legal minefield. If you're still treating real estate like a set-it-and-forget-it income stream, you could be walking straight into a financial disaster. In this video, we're revealing 10 shocking landlord laws that were just passed across Canada. And trust us, they're not what you'd expect. From nationwide rent freezes and strict eviction bans to surprise environmental compliance rules, these legal changes are already blindsiding even the most experienced investors. You could be fined, forced to hold on to underperforming units, or worse, have your property rights stripped out from under you. This isn't fear-mongering, it's happening. And if you don't know these laws, you're at serious risk. Number 1. Rent freeze expansion could trap your cash flow. For decades, landlords relied on gradual rent increases to stay ahead of rising costs. But now, that basic principle is under attack. In 2026, the Canadian government extended a nationwide rent freeze policy in designated housing crisis zones, which include major cities like Toronto, Vancouver, and parts of Montreal. In these areas, rent increases are capped below the rate of inflation, meaning even as property taxes, maintenance costs, and interest rates rise, your rent prices stay put. For many landlords, this has created a dangerous financial squeeze. Monthly profits are evaporating, and expenses are piling up with no legal way to adjust for them. Surprisingly, this law isn't just targeting big landlords. Even mom-and-pop investors with a single rental unit are feeling the burn. The freeze applies regardless of your mortgage rate or personal situation, and attempts to sidestep it, like renovictions or relisting units, are being closely monitored by housing authorities. Failure to comply could result in fines up to $25,000, along with tenant compensation. What's more troubling is that the freeze can be extended year after year with little warning, leaving investors in a long-term holding pattern they didn't sign up for. To protect your investment, it's crucial to analyze local rent control rules before purchasing or renewing a lease. In some provinces, rent caps are tied to CPI, Consumer Price Index, while others impose stricter limits. Smart landlords are beginning to shift strategies, like offering premium upgrades to attract higher initial rent or focusing on short-term rentals in exempt zones. But the bottom line is clear. If you don't adjust, you'll bleed money. The old buy-and-hold strategy is no longer a guaranteed winner in Canada's biggest markets. Do you agree with this rent freeze, or do you think it's killing small investors? Drop your thoughts below. We actually read them. And if you appreciate the deep dive, hit that subscribe button. It's just one click, but it means everything to us. Number 2. Renovictions are now practically illegal. Across Canada, the practice of renovicting tenants, removing them under the premise of major renovations, has long been a way for landlords to refresh a unit and relist it at market rates. But as of 2026, this tactic is no longer just frowned upon. It's being strictly outlawed under new federal housing protections. Landlords are now required to obtain written approval from their provincial housing board before initiating any eviction tied to renovations. And getting that approval? It's harder than ever, with the burden of proof squarely on the landlord to show that renovations are both necessary and uninhabitable during the process. Even worse, the rules apply to both major and minor upgrades. Something as simple as installing new floors or redoing a bathroom may no longer qualify as valid grounds for ending a lease. In most provinces, tenants also have the first right to return, meaning that even after spending thousands on improvements, you could be legally obligated to bring the same tenant back at their old rent. For landlords banking on value-added flips or cash flow boosts from modernized units, this law slams the brakes on that strategy. It also creates an environment where holding onto underperforming leases becomes a long-term headache. This doesn't mean renovations are impossible, but it does mean you need a smarter plan. Some landlords are beginning to focus on vacancy-based renovations, waiting until tenants leave voluntarily before making upgrades. Others are pivoting to new construction builds or investing in regions with more flexible legislation. Either way, if your strategy relies on tenant turnover, you're walking a fine legal line. Fail to follow these new guidelines, and you could face massive penalties, plus a permanent black mark on your landlord record. What do you think? Are renovictions being abused, or is this a step too far? Let us know in the comments, and if this helped you stay ahead, don't forget to hit subscribe. It's one click, but it fuels everything we do. Number 3. Green retrofits are now mandatory. Starting this year, Canada's new Environmental Housing Compliance Act is making waves in the rental market, and not in a good way for landlords. Any residential building over 15 years old is now required to meet strict energy efficiency standards, including the installation of heat pumps, upgraded insulation, energy-efficient windows, and smart thermostats. While these changes may sound environmentally responsible, the reality for landlords is far more brutal. Retrofit costs can exceed $20,000 per unit, depending on the size and condition of the building. And if you don't comply by the government's deadline, you could be hit with annual penalties as high as $10,000. Many landlords were blindsided by this, assuming eco-upgrades would remain optional or subsidized. But the law is clear. There's no grandfather clause, and even partial noncompliance can result in steep fines or legal action. Municipal inspectors have already started targeting older multi-unit buildings, particularly in Ontario, Quebec, and British Columbia. Some landlords are even facing temporary building freezes until they submit a full retrofit compliance plan. It's no longer about choosing when to go green. It's now the law. There are, however, a few ways to soften the blow. The government is offering limited rebates and low-interest loans to assist with the transition, though they're highly competitive and come with their own red tape. Smart landlords are now building retrofit costs directly into their purchase analysis before making offers. Others are prioritizing the most cost-effective upgrades, like sealing drafts or installing programmable thermostats, while budgeting for the bigger expenses over time. Either way, ignoring these new rules could destroy your profit margins and even jeopardize your building's license to operate. Is this a smart, environmental move or an unfair burden on small landlords? Tell us in the comments, and please hit subscribe if this helped you stay informed. It's one simple click, but it keeps this channel going. Number 4. Evicting tenants now takes 90 days or more. Until recently, ending a lease was relatively straightforward in many provinces. But with the 2026 amendments to tenant protection laws, landlords are now required to give a minimum of 90 days notice to legally terminate a lease, even if the lease is expiring or being ended for valid reasons like personal use or sale of the property. This extended notice period has become a major pain point, especially for landlords trying to line up renovations, sales, or new tenants around specific timelines. What makes this law even trickier is that it's not limited to bad tenants or special cases. Even clean, rule-abiding terminations now require this extended lead time. In hot real estate markets, 90 days can make or break a deal. If you're planning to sell, the extra delay could result in missing out on a buyer, or worse, having to postpone the transaction entirely. In some provinces, if you fail to give exactly the right type of notice in the correct format, the termination could be invalidated, forcing you to start the clock all over again. Landlords now need to be hyper-organized and proactive. That means understanding your local lease laws down to the letter, giving notice well ahead of time, and having a plan B if things don't go smoothly. In some areas, written notices must be delivered by hand or registered mail, not just emailed or texted. And if tenants dispute the termination, the case may end up before a housing tribunal, dragging the process out even longer. Bottom line, if you're not strategically timing your leases and exits, you're at risk of losing time, money, and opportunities. Have you ever been caught off guard by a lease notice rule? Share your story below. And if you're finding value here, subscribe now. One click helps us keep bringing you content that actually matters. Number 5. Income verification restrictions are raising risks. Traditionally, landlords relied on verifying a tenant's income to assess whether they could reliably pay rent. But under new 2026 legislation in provinces like Ontario and British Columbia, landlords are now restricted for requesting detailed income verification for tenants receiving government housing assistance or falling under certain protected classes. The goal? To prevent income discrimination. The problem? It leaves landlords blindfolded when it comes to evaluating financial risk. This law means you can't ask for traditional pay stubs, T4 slips, or even bank statements in some cases. Instead, you're limited to accepting minimal or alternative forms of proof, often provided through housing support programs, which don't always reflect the tenant's full financial situation. For small landlords especially, this creates an unnerving level of uncertainty. You may be forced to sign leases without truly knowing whether a tenant can afford the unit long-term. And if things go wrong, evictions still take months and come with steep legal costs. To stay protected, landlords are turning to creative but legal screening methods, like reviewing previous rental history, checking credit scores, where permitted, and contacting past landlords. Some are even working with third-party screening services that specialize in navigating these new rules. While it's still possible to make smart tenant choices, the process is now far more delicate. You'll need to balance compliance with caution and stay well-informed on exactly what's allowed in your province to avoid fines or accusations of discrimination. Should landlords be allowed to fully vet income, or is this restriction fair game in the housing crisis? Drop your opinion in the comments. And if you've ever faced tenant troubles, hit that subscribe button. One click helps us keep making content that protects investors like you. Number 6. Illegal short-term rentals now carry criminal charges. In a move that's sending shockwaves through the real estate world, major Canadian cities like Toronto, Vancouver, and Montreal have escalated their crackdown on illegal short-term rentals, and in 2026, they've taken it to a whole new level. What used to be a ticket or a fine is now considered a criminal offense in some jurisdictions. That means landlords caught running unlicensed Airbnb-style units could face court summons, criminal records, or even jail time if convicted. It's no longer just about breaking city bylaws. It's about breaking the law, period. What's triggered this harsh response? Housing affordability. With rental vacancies at historic lows, municipal governments are blaming the explosion of short-term listings for reducing long-term rental availability. In response, cities have imposed tight registration rules, caps on rental days, and zoning restrictions. And now, enforcement teams are actively monitoring platforms, using algorithms and tenant reports to hunt down unlicensed operators. Even just one unit, if unregistered, can lead to massive consequences. If you're in the short-term rental game, it's not over, but you need to play it smart. First, make sure your property is in a zone that allows short-term stays. Then, register with your city, pay the required taxes, and comply with occupancy limits. Some investors are now pivoting to mid-term furnished rentals, targeting traveling professionals or students for 30-plus day stays, which often bypass strict regulations. But no matter your strategy, remember, one mistake could put your entire business at legal risk. Are short-term rentals being unfairly targeted, or are these rules long overdue? Tell us what you think in the comments. And if this info saved you from a costly mistake, hit that subscribe button. One click really powers everything we create. Number 7. Landlord licensing is now mandatory in many cities. Quietly but powerfully, a new wave of regulation has arrived in Canada's urban centers, mandatory landlord licensing. As of 2026, cities with populations over 100,000, including Calgary, Mississauga, and Halifax, are now enforcing annual landlord registration programs. What used to be a voluntary process in some areas is now a legal requirement, with fees, inspections, and paperwork baked in. For many landlords, especially those managing just 1 or 2 units, this adds a new layer of red tape and financial pressure that's hard to ignore. This isn't just a registry. To maintain your license, you may have to submit maintenance records, tenant complaint histories, safety compliance forms, and proof of proper insurance. Fail an inspection, you risk a license suspension, meaning you can't legally rent out your property until all issues are resolved. In some cities, repeat violations can even result in your name being added to a public bad landlord list, which could harm your reputation and future investment opportunities. Simply put, if you thought real estate was a passive business, this law proves otherwise. To stay compliant and profitable, you need to start treating your rental like a professional operation. Keep clear documentation, respond quickly to maintenance issues, and familiarize yourself with your local housing code. If you're managing multiple properties, it may be worth hiring a licensed property manager to handle inspections and filings. But even solo landlords need to take this seriously. Licensing isn't just a formality anymore. It's the new baseline for participation in the rental market. Do you think landlord licensing will raise standards or just push out small investors? Drop your take in the comments and hit that subscribe button if you found this breakdown helpful. It only takes one click, but it keeps our videos coming your way. Number 8. All evictions now go into a national landlord-tenant database. One of the most controversial changes of 2026 is the launch of Canada's new national landlord-tenant reporting system. Under this law, every eviction, successful or not, must be reported to a centralized government database. This includes notices served, tribunal hearings, mediated settlements, and formal evictions. While it was introduced as a tool to protect tenants from repeat offenders, it's quickly becoming a double-edged sword for landlords, especially those managing high-turnover units or dealing with difficult tenants. Many landlords don't realize that even if they follow the law step by step, simply filing an eviction notice puts them on record. If that eviction is challenged or overturned in a tribunal, it still appears in the system. Over time, this data could be accessed by insurance companies, mortgage lenders, tenant advocates, and even municipalities. That means your track record as a landlord is now public and permanent, affecting your ability to refinance, expand, or defend future disputes. It's no longer just about doing the right thing. It's about how many times you've had to do it. To stay protected, landlords must be extremely cautious about initiating evictions. Focus on mediation and documentation, and consider hiring legal counsel for borderline cases. Keep detailed communication logs, inspection photos, and payment records to back your claims if things escalate. And remember, even a clean eviction can carry a reputational cost if you rack up too many entries in the system. From now on, eviction should be your last move, not your first instinct. Does this kind of tracking make landlords more accountable or more vulnerable? Let us know in the comments. And if this helped you stay ahead of the curve, subscribing takes just one click, but it drives everything we create. Number 9. Vacancy tax now applies nationwide. What started as a localized policy in Vancouver has now gone federal. In 2026, Canada rolled out a nationwide vacancy tax on residential properties left unoccupied for more than 6 months in a calendar year. The rate? Anywhere from 1% to 3% of the property's assessed value every single year. That means if you own a $700,000 condo that sits empty, you could owe up to $21,000 annually, even if you're not collecting rent. For landlords with second properties, vacation homes, or long-term vacancies, this is a game changer, and not in a good way. Unlike before, this tax isn't just applied in major urban centers. It now covers nearly all provinces, with each municipality having the right to enforce and increase rates locally. And enforcement is no joke. Cities are using utility records, postal activity, and even digital surveillance tools to determine occupancy status. If you're caught trying to game the system, like listing a unit for rent without actual tenants, you could face hefty penalties and audits. The government is watching closely, and your margins may vanish if you're not careful. The smartest landlords are already pivoting. Some are turning their vacant units into short-term or mid-term rentals, while others are partnering with property managers to keep the space consistently occupied. There are also exemptions available, such as for renovations, medical reasons, or temporary relocations, but these must be officially declared and documented. The key takeaway? Vacancy is no longer neutral. If your unit isn't generating income, it's draining your wallet. Do you think a nationwide vacancy tax is fair, or is it punishing responsible property owners? We'd love to hear your take in the comments. And if this saved you from a surprise tax bill, support the channel with a quick subscribe. It only takes a second but means the world to us. Number 10. Corporate landlords face a new 5% surtax. In an unexpected blow to investors, the federal government introduced a 5% surtax on gross rental income for properties owned by corporations, trusts, or numbered companies, a move aimed at curbing what officials call institutional overreach in a housing market. If you're holding real estate under a corporate entity, this applies to you. The tax is levied on total rent collected, not net profit, which means even if you're barely breaking even, you could still owe thousands in extra taxes just for the structure you chose to protect your assets. Unlike typical income taxes, this surtax is automatic and comes with very limited exemptions. The only major relief is offered to landlords who can prove active management involvement, which means showing payroll records, maintenance logs, and daily operational oversight. Passive investors or those using corporations strictly for tax or liability reasons will likely be hit hardest. It's a major shift that could change how small and mid-size investors structure future property purchases, especially in provinces where personal liability protections were once a key advantage. As a result, many landlords are now re-evaluating their corporate holdings. Some are considering joint ventures or personal ownership structures, while others are seeking legal advice on how to restructure portfolios to minimize the damage. If you've been operating under the assumption that a corporate shell offers the best protection, this new law may force you to choose between asset safety and financial viability. Ignoring it could cost you more than just money. It could make your whole strategy unsustainable. Do you think this surtax is targeting big players or unfairly punishing small investors trying to stay safe? Let's talk in the comments. And if this heads up helped you avoid a financial trap, hit that subscribe button. One click makes a huge difference for our channel. The truth is, being a landlord in Canada has never been more complicated. What once felt like a stable, predictable investment now demands sharp attention, legal awareness, and constant adaptation. The laws we've covered in this video, rent freezes, and-term evictions, mandatory retrofits, extended eviction timelines, and taxation changes, aren't just minor updates. They are fundamental shifts in how real estate works, and if you're not adapting, you're already falling behind. But here's the thing. While these changes may seem overwhelming, they also open the door to a new kind of investor, one who's informed, strategic, and agile. If you take the time to understand the rules, structure your investment smartly, and plan ahead, you can still succeed in this new landscape. The key is to stop treating real estate like passive income and start treating it like a business that requires active management and policy awareness. It's also clear that governments are pushing hard to rebalance power in the rental market, and landlords who resist change may find themselves buried under fines, legal disputes, or failed investments. But those who stay educated, flexible, and proactive will continue to find opportunities where others see obstacles. Because in real estate, knowledge isn't just power, it's profit. If you made it this far, we want to hear from you. Which law do you think will impact landlords the most, and which one shocked you the most? Drop a comment and let's have a real conversation. And if you got value from this video, please support us by subscribing. We put hours of research into every episode so you don't have to. It's just one click, but helps us more than you know.